Today, ladies and gentlemen, I believe this is your last chance to get decade high plus dividend yields that we are currently seeing from the Canadian banks. I'm currently buying super aggressively through one of my favorite Canadian dividend ETFs, but I have an even better bank ETF that is equal weight with zero fees. But what we're going to do is take a look at all the big banks because we're heading into a pivotal earnings season from November 28th to December 1st. We're going to talk about TD, Royal Bank, BMO, CM, BNS, National Bank, all your favorites, to see where their yields sit, what the charts currently look like, so we can get an expectation for what's going to happen moving forward, and of course my personal opinions. If that is a conversation you'd appreciate, as always, hit that like button as a fellow Canadian looking for that juicy passive income unlike anything we've ever seen. I swear we've literally never seen a market quite like this, and it represents one heck of an opportunity. And here we have the Horizons Equal Weight Banks Index. This is a fascinating ETF that one of you gladly recommended on my live stream last week that really just represents an equal weighting in all the big banks, but in a very unusual way, because unlike many of the bank ETFs that exist out there that come with really high fees, this one is currently offering a 0% management fee until July 31st of 2024. And as their fees come into play, they're only going to be charging 0.09%, which is currently lower than one of my favorite ETFs, VDY, which is kind of mind-blowing, all things considered. And if we do just take a look at the holdings, it is very much just an equal weight bank ETF with all your favorite banks perfectly equally weighted. And what makes this ETF even more intriguing is they kind of point out some fascinating facts, like the annualized growth rate of dividends for the big six Canadian banks was 9.9% for the last 25 years from 1998 to 2023. And they're currently going to be offering basically a monthly paying, ETF with a yield of 5.78%. You know how insane that is? That's like a full market rate of return almost just from the dividend yield, but that's based on October 31st. But let's take a look at the banks. Let's see what's currently going on, and we'll talk about what I've been buying and my current thoughts around this entire sector. Now, Royal Bank is bouncing up. It hit about a 11 to 12% basic, capital jump from the October lows, which was very nice to see. I'm currently speculating that we saw the bottom. October seems to be a weird, unusual time in the market where it just tanks miserably and then recovers and spends the next 6 months just trickling back to the upside. And I'm very, very much predicting that this is what we're going to see yet again. I could be wrong. It's just my speculation, but the things have gotten oversold here. The entire Canadian banking sector, through all the fear of people thinking housing's going to collapse, credit cards are going to default, it's just not what's actually materializing. And right now we're getting about a 4.5% yield. If we take a look at that yield at 4.5%, which by the way, it peaked at almost 5%. We hit 4.9. I think that's come and gone because anytime we see a huge spike in Royal Bank's dividend yield, again, it's historically followed by the stock rebounding. And that's exactly what it seems to be repeating. But there's only been 3 times in Royal Bank's entire last 25-year history that we've ever seen yields come close to being this high. And if we take a look at their revenue, yes, they're putting loan loss provisions aside. Yes, it's been deteriorating some of the net income, but that's just because of the rockier environment we sit in where loan quality has been degrading, but not really defaulting. Again, I want to iterate that during the pandemic, mortgage defaults, credit card defaults were much, much worse than the market we're currently sitting in because people have jobs and they are fighting to keep their house. And if they can't afford their house, they're selling it. Someone's there to buy them out of the mortgage. We're not seeing a crashing market here, folks. But take a look at total revenue, because the revenue for the last quarter, which was basically $14.4 billion, was basically a Q3 record for them past any year prior. Because typically they're doing about $12 billion on Q3, but even for the 9 months, so the year to date, they did $43 billion versus $36 billion this time last year. So this company, unlike Apple, is continuing to grow revenue. Like a few tech companies can't even keep growing revenue like this, which just shows you how fast the Canadian economy is growing, right? Because we have record immigration. You look at something like Toronto Dominion Bank here, which let's just zoom in on a year to date. Year to date now, it's only trading down about 5%. From the recent highs, though, these things are down dramatically. I mean, look at that, 25 to 30% lows, which is just crazy. But off the recent jump, again, like Royal Bank, this thing is up about 9-10%, kind of getting to the double-digit range with the current 4.6% starting yield. A little bit better of a price-to-earnings multiple. And again, when we take a look at that dividend yield, there's really only been 2 times in history outside of the pandemic the yields even come close to getting this high. And if we zoom out through its full history here, you can just get a full perspective. The bottom line on this chart here, just representing, even if you go back to 2002 during the dot-com era, you could have got a 4.65% yield, but very few times in history you get these glimpses of, oh my God, juicy passive income. And again, from that revenue standpoint, $12.7 billion, which if we take a look at some of the other prior quarters, in 2022 it was $10.9 billion. In 2021, you're talking about 10.7. And again, for year to date, 37 billion versus 33 billion in 2022. Let's take a look at National Bank, one of the best performing banks, takes on a little bit more risk, get a little bit more growth here, and even a better price to earnings, 4.55% yield. This has been one of the better performers. It's really only down 2% year to date and is up not as much as the other banks on the October low rally, but that's because it's not down nearly as much, right? I mean, it's only down about 15%. It barely touched being down 20%. And this one, I couldn't really get the current yield data on it, but this one's been much more of a stabilizer with about 2.5 billion in income. And again, we're not even talking about stellar growth here for Q3 because, the year prior was 2.4 and the year in 2021 was 2.2. On the year to date, they did 7.5 billion versus 7.3. Like, there's not even incredible growth out of this bank. It's just crazy how it's been much more of a stabilizer, and it's done very well in its past. Just in the last couple of years, we haven't seen as much growth as the big banks have been growing. So let's look at some of the other banks. People love like Bank of Montreal, which I think is some of the harder hit banks. Again, down 25 to 30% from the peaks that it experienced. And again, off the October lows, it's trading up about 7%. Not seeing the same kind of rallies the other banks, but we're talking about a 5.3% starting dividend yield, which in BMO's history, again, let's zoom out to the last 25, 30 years. Basically, during the 2008 financial crisis was a great time to be buying. You did get some pretty high yields in 2012 as well, but up to that point, I think it was during the pandemic, you almost got a 6% yield, and now, so maybe 4 times in its entire history that dividend yields have presented this kind of opportunity. And again, from the revenue standpoint, if we just take a look at the top line here, we're talking about 7.9 billion, which again is much better than, let's say, this is for Q3. If we go back to 2022, it's about 6.1 billion, give or take. And if you go back to 2021, 7.5 billion. So we're not talking about like staggering growth on a year-to-date basis. It's probably the worst performer, from 22 billion this year versus 23 billion for this time in 2022. So unfortunately, BMO has actually been one of the worst performing Canadian banks of the bunch, but we can't expect perfection across the entire board, right? So they're seeing some declining revenue. It's not the thing I'm the biggest fan of, but let's talk about the worst, most hardest hit banks from a stock chart perspective, because you look at something like Canadian Imperial, it is down a whopping 40%, 47% from the October lows. I mean, it stepped back so far in time to prices you could have got. I mean, it's kind of nuts, really. This bank hasn't seen any real growth from like 2006 at this point. It's just been a complete flat line with an entire rate of return coming from the dividend yield. However, a 6.5% dividend yield is a very healthy rate of return, especially if that dividend's been growing over time, which it has with Canadian Imperial Bank. So if we take a look at the current yield at 6.3, 6.5%, again, we can go back to basically, again, 25 plus year history. And it just gives you a full representation of how high this really is, because to get into these yields, 2002, basically during 2013, which was coming out of the 2008 financial crisis, could have got a pretty good yield. So again, maybe 4 times you've been getting close to 7% yields. The revenue, however, let's take a look at 5.8 billion for Q3. If we go back to 2022, it was 5.5, and if you go back to 21, it was 5. On the year to date, 17.4 billion versus 16.4 billion in 2022. So presuming there's getting hit on the bottom line EPS, which we can see their EPS on all these banks because of loan losses and other issues, they've been deteriorating, but that's going to change when the market environment starts to recover, folks. That's why I'm thinking we're in this wicked oversold territory where eventually there's going to be a reflection back to the upside far greater than I think most people are anticipating. So let's take a look at Bank of Nova Scotia here. Another really cool bank yielding 7% currently, probably one of the highest yielders, which is again down like Canadian Imperial from 35 to 40%, just absolutely devastated, wiping out 15, 20 years of gains in this stock price. Again, just absolutely staggering stuff. If you take a look at the dividend here, basically outside of the pandemic, there's been no time in Bank of Nova Scotia's history where it's yielded this high of a dividend. So only 2 times. Think about that. For as long as this company's been publicly traded, basically with the data here going back to 2000, so we're looking at, damn near 23, 24-year history, there's only been 2 times in 24 years, which is basically most of my entire life, that the starting yield has been this damn high. Just think about how, historic that is. You're talking about total revenue of $8 billion versus this time last year. If we take a look throughout the prior quarters, there actually hasn't been a real time. They're only showing me basically for the last few quarters here, but on the 9-month ending, let's just take a look year to date, about 24 billion versus about 23.79 billion this time in 2022. So the growth has been stagnant, but it is still trickling to the upside, and people have been really beating these banks into the ground. But honestly, so BMO is the only one with declining revenues as it stands in this moment. And again, most of them I think are incredibly oversold. So how have I been aggressively buying into the banks? I've been primarily just utilizing VDY. In fact, I bought more VDY today, but I'm still starting to think I should be buying some of these banks on an individual level, or buying one of these equal weight bank ETFs just to get that broad exposure. But I do like VDY. I think it's one of my favorite ways to the Canadian economy because it does yield over 5%. It is a monthly paying. The management fee is much higher, however. And they've been doing some adjustments to this ETF. As we take a look and scroll down, we can see the vast majority of the exposure is 54% financials, and most of those financials are the big banks that sit at the top. In fact, 25% of this ETF, roughly 24-25%, sit in Royal Bank and Toronto Dominion Bank. So basically for every $1,000 I put in, 250 are immediately going to these two big banks, which I appreciate. But then you've also got 5% going to Bank of Nova Scotia, another 6% to Bank of Montreal. So you tap that on, you're looking at 35% just going to basically these four big banks. So I feel like I'm getting good diversification because I also love Enbridge. I think Enbridge is trading at a good price. Canadian National Resources I think is a little expensive, but obviously people are expecting that, the natural gas being one of the largest, reserves on the planet is going to be a huge proponent to Canada's energy future. I just love this ETF. And again, I think it just gives me an easier way of diversifying my money instead of me having to buy all these individually. But what do you think? Do you like BDY? Are you buying it here? Do you like this New Horizons Equal Weight Bank ETF? Either way, I recommend to always be buying right now because these opportunities are sparse and far and few in between. And I'm aggressively doing everything I can, as I will be updating my portfolio tomorrow, as I always do on this channel. So consider subscribing for those updates.